We are diving deep today into something pretty revolutionary, actually. Real estate tokenization. The whole idea is turning property, bricks and mortar, whether it's your house or a huge office building, into something you can trade almost instantly. Yeah, like
Mhm.
24/7, just like trading stocks. It's a big promise. And our listener, you wanted us to figure out how blockchain and these things called smart contracts are actually being used in real estate deals around the world. Not just a theory, but, what's happening on the ground. So our mission today is to sift through the sources you sent, pull out the key bits about how the tech works, what the big benefits are supposed to be, and crucially, what massive hurdles, regulatory, cultural, are getting in the way of this prop tech future.
Right. So maybe it's good to start with the basics. Just a couple of key terms. First up, the smart contract. You can think of it as a kind of digital agreement that runs itself. Its code lives on a blockchain, and it basically acts like an automated, trustless escrow agent.
Trustless, meaning you don't need to rely on a third party like a bank or an escrow company.
Exactly. Once certain conditions are met, like the funds are confirmed, the digital title is ready, the contract just executes, boom, transfers the asset, releases the payment automatically.
Okay, so it's verified, it's automatic, cuts out a lot of the human steps. Got it.
Precisely. And the second term is real estate tokenization. This is the process where you take the value of a real property or even just the income it generates, like rent, and you convert that into digital tokens on a blockchain.
So tiny digital shares of a building.
Essentially, yes. Verifiable fractional shares of the actual asset.
Okay, let's unpack that a bit. I mean, we've bought and sold property the old-fashioned way for, well, forever.
Right.
Why does that traditional system actually need fixing? What are the main problems this tech is supposedly solving?
Well, the traditional way is just slow and expensive. There are several big pain points. First, there's incredibly high friction and cost. Deals take ages, mountains of paperwork, and you've got all these intermediaries, brokers, lawyers, banks, title companies.
Right, everyone takes a cut.
Everyone takes a cut. And your sources point out that the transaction costs alone can easily eat up 5, maybe 6% of the property's value.
Wow, 5 or 6% on $1 million property? That's a lot of money just vanishing into the process itself.
It really is. And that ties into the second issue, lack of liquidity. Real estate is famously illiquid, right? Selling a property can take months, sometimes years.
Yeah, you can't just sell your living room if you need some quick cash.
Exactly. It's impossible to sell just a piece of it without offloading the whole thing. Which brings us to the third point, the high barrier to entry.
Meaning you need a ton of cash up front.
A ton. You often need huge amounts of capital just for down payment, which means historically investing in high-value properties like commercial buildings has been mostly for institutions or, very wealthy individuals,
So it keeps smaller investors out. A closed shop.
pretty much.
I don't know.
And finally, there's the risk of fraud. Some of the existing land registry systems are, frankly, outdated. They can be vulnerable to manipulation.
How s-
Well, manipulating ownership records, leading to disputes, even outright title fraud or people forging deeds. The system often relies on trusting paper records, which aren't always secure, instead of having something digitally verifiable and, well, tamper-proof.
Okay, so that's the old way. Slow, costly, hard to access, and even a bit risky. How do smart contracts and tokens specifically fix these things? Let's start with the speed issue. You mentioned traditional closings taking 30, maybe 60 days.
Yeah, easily. Automation is the key here. Smart contracts can automate almost everything, verifying information, transferring funds, updating the title record on the blockchain. This could potentially slash closing times from weeks down to just days, maybe even hours in some scenarios, assuming the legal side recognizes the digital process.
Okay, hold on. If you cut out, say, the title company, the folks who charge maybe $1,000, $2,000 to research the property's history and ensure the title who takes responsibility if something goes wrong, like if the smart contract code has a bug or if there was fraud before it got tokenized.
That's a really important point, and honestly, it's one of the big things regulators are grappling with, who holds liability. But the technology itself tries to address the future risk through immutability. The blockchain is essentially an unchangeable ledger. Once a transaction is recorded, it can't be altered or deleted. That seriously reduces the chances for new fraud, though obviously you still need legal ways to deal with historical issues.
Okay, so it helps prevent future fraud and the cost savings.
By automating functions and cutting out some intermediaries, the projections are pretty dramatic. We're talking potential cuts to closing costs of maybe 50 to 90%.
Wow. Okay. And that brings us to tokenization itself. That tackles the liquidity and accessibility problems.
Exactly. You take the property, divide its value into digital shares or tokens. The example in the sources was pretty clear. A $1 million building gets split into, say, 1,000 tokens, each representing the $1,000 of value.
And then people can buy and sell those tokens easily.
Precisely. They can be traded potentially 204/7 on secondary markets. That immediately makes the asset much more liquid for the owner and for investors.
Yeah, the accessibility piece sounds huge. You mentioned examples like platforms selling bits of U.S. properties for just $50 or part of a Berlin apartment for $500.
That's right. It dramatically lowers that huge capital barrier we talked about, sort of democratizes access to real estate investment.
So what's the tech that makes this work smoothly? You mentioned immutability, but there was something else.
Yes, there's a bit of technical detail that's quite clever. It involves using advanced multi-token standards on the blockchain, specifically something called ERC 1155.
ERC 1155. Why does that specific standard matter for, our listener trying to understand this?
Well, ERC 1155 is interesting because it lets a single smart contract manage two different kinds of tokens at once. It can handle the fungible tokens, those 1,000 identical shares representing value,
Okay, the fractional shares.
right? And it can handle the non-fungible token, or NFT, which represents the unique property right itself, like the digital deed.
Ah, so one contract controls both the shares and the underlying ownership title.
Exactly. It bundles the fractional investment side and the core property right together in one efficient package. This simplifies the structure quite a bit, potentially making the legal side easier to manage too.
Okay, the tech sounds really powerful. Smart contracts, tokens, ERC 1155. It seems like a clear upgrade. But the real world always throws curveballs. We found two really different stories about how this is actually playing out. One showing government ambition, the other showing, well, some serious ground level problems. This is where it gets really interesting, I think.
Yeah, the contrast is stark. We absolutely have to talk about Dubai. They're kind of the poster child for government embracing this tech. They've been really aggressive with their blockchain strategy. Their stated goal is to get like 100% of applicable government transactions onto the blockchain eventually.
So the government itself is pushing this. It's not just private companies hoping for friendly rules.
Oh, absolutely. The government is driving it. The Dubai Land Department, the DLD, they've already rolled out blockchain systems for title registration, making it secure, immutable, basically instant. They're also actively piloting smart contracts, especially for things like off-plan property sales, which can be risky for buyers. This helps reduce fraud, particularly for international investors. They're essentially building the rails for a transparent, automated property market from the top down.
Okay, that's the high-tech, ambitious future. Now, what about the flip side? The cautionary tale from the Philippines. We saw this proposal from a startup there. They wanted to use smart contracts for escrow. The tech seemed fine. They figured out how users could use regular money, the Philippine peso, through compliant exchanges using stablecoins like USDT to avoid currency swings.
Right. The technical plan was sound,
Yeah.
but it ran smack into the messy reality of human behavior and, frankly, entrenched systems. Commenters on the proposal immediately flagged the crazy levels of regulation. But the real killer, the deeper issue, seemed to be widespread tax evasion. It's profitable.
Ah, you're talking about under-declaring the value of properties on official documents.
Exactly. It's apparently a common practice. You sell a property for, let's say, 10 million pesos, but the official paperwork only shows 7 million.
And the other 3 million changes hands how?
Cash, under the table.
Hmm.
This way, both the buyer and the seller pay less tax.
Okay, I see the problem. A technology built on perfect, verifiable, transparent records completely blows that system up, doesn't it?
It absolutely does, and that's the core irony, right? Blockchain offers tamper-proof transparency. But if a significant part of the economy relies on avoiding transparency to function or to profit, well, why would you adopt a system that exposes everything?
So the Philippines example really highlights that this isn't just about cool tech. It's about whether the political and cultural environment is actually ready for that level of honesty.
Precisely. It shows the limits of tech when it confronts ingrained habits and, let's be honest, profitable deception. Adoption hinges entirely on the will to change those things.
That context makes the legal side even more complicated, doesn't it? The tech might be ready, but the rules are all over the place. Why is regulatory uncertainty seen as the single biggest roadblock holding back this whole global market?
Yeah, it really is the elephant in the room.
Yeah.
And it starts with a fundamental disagreement. What is a real estate token legally? Different countries, even different agencies within countries, can't agree. Is it a security, like a stock? Is it a cryptocurrency? Or is it something totally new that needs its own rules? This classification conflict is huge.
And if it gets classified as a security, especially in the US, that triggers a whole avalanche of regulations, right?
Massive avalanche.
Yeah.
In the U.S., they use the Howey test. It's a legal standard to figure out if something is an investment contract, which basically means it's a security. The test asks, roughly, are you
Look,
investing money,
yeah.
expecting profit? And is that profit coming mainly from someone else's efforts? If yes to all, it's likely a security.
And if it is,
Then the issuer has to comply with all the federal securities laws. That often means registering with the SEC, which is expensive, complex, and takes a long time. The uncertainty is so high that many companies doing tokenization just decide to treat their tokens as securities from the start, just to be safe and avoid potential violations later.
okay, so classification is messy. But even beyond that, there are other compliance burdens, like preventing money laundering.
Absolutely. You can't just bypass existing financial regulations. Issuers still have to implement strict anti-money laundering,
Right.
AML, and know your customer KYC procedures.
So verifying identities, checking sources of funds, monitoring transactions.
All of it. Yeah. Which adds layers of complexity, especially when you're dealing with a technology designed for potentially fast, orderless transactions. And then there's tax confusion. The IRS in the U.S., for example, treats crypto and digital assets as property for tax purposes, not as currency. So every time you sell or trade a token, even for another token, it could be a taxable event subject to capital gains or maybe income tax. Trying to track that across different countries, well, it's an accountant's nightmare.
But isn't the most fundamental legal problem the link between the token and the actual dirt? If I own a token representing a share of a building, do I legally own part of that building?
Yes. This is probably the biggest legal gray area, and honestly, it's largely unresolved globally. In most places, the existing property laws simply do not recognize a digital token as valid proof of ownership for physical real estate.
So the token itself doesn't give you title.
Not directly, in most jurisdictions, which is why most current tokenization projects use a workaround. They typically set up a legal entity, like a limited liability company, LLC, that officially holds the property deed, the traditional paper title.
Okay.
Then, investors buy tokens that represent shares or membership interests in that LLC. So you own a piece of the company that owns the property, not a direct piece of the property itself through the token.
Wow. So even with this super advanced immutable blockchain ledger, the old-fashioned government-registered paper deed is still king in the eyes of the law.
In most legal systems, yes. The blockchain acts more like a sophisticated financial ledger for the investment vehicle, rather than a replacement for the official land registry, at least for now. And one last point on regulation. Because these tokens are often treated as securities, they generally can't be traded on just any crypto exchange. They usually need to be traded on regulated platforms,
Right.
like alternative trading systems, ATSs.
And are there enough of those?
No, that's the problem. There's a real shortage of ATSs equipped or willing to handle these tokenized real estate assets.
Yeah.
This lack of compliant trading venues creates another significant barrier, making it hard for these assets to actually become liquid. Hashtag tag outro.
Okay, so we've gone through the tech, the potential, the real-world roadblocks in places like Dubai and the Philippines, and this huge regulatory iceberg. What's the main takeaway here for someone watching this space?
Well, the core message is kind of twofold, isn't it? The technology itself, smart contracts, tokenization, blockchain ledgers like ERC 11.55, it really does seem ready. It directly addresses those fundamental problems of cost, illiquidity, and accessibility that have plagued real estate for ages. The potential to unlock trillions in value globally is there. But this innovation is slammed right up against messy reality. It's stuck in this complex web of outdated laws, conflicting regulations across borders, and as we saw in the Philippines example, sometimes a cultural or economic resistance to the very transparency the tech provides. The future hinges on solving the legal and political knots, not really the technical ones anymore.
It sounds like the classic story. Technology sprints ahead, while law and human habits lag way behind. Thank you for breaking down all these complex sources for us and for you, the listener.
My pleasure. And maybe one final thought for you to consider. We talked about how blockchain gives us this perfect, immutable record of who owns what financially. But if the legal system doesn't accept that digital record as proof of ownership for the physical property, what's the most valuable thing blockchain is providing right now? Is it just a better way to manage fractional investments like a super efficient ledger? Or can it and will it eventually become the actual legally recognized title registry itself? How countries answer that question will really shape the next decade of property technology, or PropTech.